Today is Sunday, January 31st. Can you believe it? We're already done with the first month of the year. But anything is believable these days, even false narratives. What are we talking about here? We're talking about the GameStop story. It has become a global phenomenon. And now the news media, politicians, celebrities are talking about it. And what a colossal of ignorance it is when people who have no clue how financial markets work start talking about it. And perhaps the most stunning aspect of all of this is when you realize that our politicians have no clue how the market works. What are the mechanics of the market? Our politicians have absolutely no clue. We heard from a lot of them last week, Republicans, Democrats, and they have just illustrated the lack of understanding of how the stock market works. This is supposed to be the market that they are regulating, and they have no clue how it works. Furthermore, everybody right now is drinking the Kool-Aid. Everybody has bought the false narrative. What we are seeing in GameStop stock is an uprising from the common man against the greed of Wall Street. It is David versus Goliath. But in fact, it is not. And when it's all said and done, the number one beneficiary of what's about to happen is Wall Street firms, specifically the biggest Wall Street firms. We're talking about JP Morgan, we're talking about Morgan Stanley, we're talking about Goldman Sachs, we're talking about BlackRock, we're talking about Vanguard and Fidelity, the owners of this country. And while we might see some casualties in the hedge funds part of Wall Street, and we might celebrate the demise of these hedge funds, nobody has any empathy for them. They've been bad actors for years and years and years. That is the sideshow, the distraction of the main story. That this is yet another inside job from the biggest firms on Wall Street to concentrate their power even further on the financial system and to emerge bigger and more powerful than before. I'll explain to you the three main objectives and outcomes that will take place once this whole thing is said and done and the dust is settled, and you will realize after I explain to you what's going on that this couldn't be further away from the David versus Goliath narrative. Yet nobody's paying attention, nobody's talking about it. Everybody has bought the story the Wall Street elites wanted you to believe. They want you to believe in the false narrative that this is an uprising from the common man against the establishment. When in fact, when it's all said and done, the establishment goals will be achieved. We'll talk about all of this and more when we discuss the situation of GameStop. I will explain to you a lot of other aspects of the story, such as the mechanics of the market and how the short float works. A lot of people are asking questions. How did the short float of GameStop stock came about to be over 130% to begin with? I'll explain that to you. And we will also discuss whether short selling is really the bad actor in the market as it perceived to be right now or not. And of course, we'll do this while we do our usual market coverage for the activities that took place on Friday and throughout last week. And stick around for the conclusion of the video because we will talk about my strategy to weather the volatility this upcoming month and beyond. But before we start, let me address another thing because there's a lot of misunderstanding regarding what happened to the stock market last week. Remember, I gave you these names and I told you these are the YOLO names. That's what I call them. You can call them whatever you want. And the list keeps growing and growing and growing. You can add costs and you can add naked brands or whatever you want to add to this list. You understand what I'm talking about. These are the heavily shorted names that retail traders are chasing right now. And when these names outperform, the shorts in these names have to cover for their shorts. Where are they going to get the money to cover for their positions? They have to sell their long positions. What are their long positions? These are the top 20 names that hedge funds are long right now. So you see the liquidation out of these names to cover the short positions in the quote-unquote YOLO names. And this is the dynamics of the market right now. As money comes out of the broader market, the big technology names, where the hedge funds are concentrated in the long positions, you see a rise in names such as GameStop, BlackBerry, Nokia, etc. And meanwhile, heavy losses for names like Apple, Alphabet, MasterCard, etc. And on Thursday, when they shut down the brokers, pretty much because the brokers were about to go out of business, specifically the smaller ones, and we're talking about Robinhood here, and we will discuss the situation with Robinhood in details. And if I think that they will go bankrupt, as soon as next week, also during the GameStop discussion. But for now, just understand that when the brokers shut down the business, you saw the inflow of money going back to the names that the hedge funds are long. And you saw that the broader market reacting positively while the YOLO names reacting negatively. So we will still witness this dynamic throughout next week and perhaps beyond. And the question is, at what point does the average market participant start to lose faith about the stock market and they start selling their stocks? Because for now, it is just a cute yo-yo game. One day we pump the YOLO names, and when the YOLO names go down, we pump the broader market. But at some point, if the dip is not bought in the broader market, then we might head into a scenario of a massive sell-off, aka a crash in the broader market. Who's been buying the dip over and over and over again to rescue this market throughout the rally since the March bottom? Retail traders. Well, retail traders now are fixated in the new YOLO names, so they don't have the resources or the interest to rescue the broader market and buy the dip, and this is the biggest threat to the stock market right now. In the conclusion of the video, I will show you my strategy to weather the storm. But for now, let's start our regular and usual market coverage. And here we go. The Dow Industrial Average closed in the red on Friday, down 620.74 points, or a decline of 2.03%. The Nasdaq down 266.46 points, or a decline of 2 percentage points even. The S&P 500 closing in the red, down 73.14 points, or a decline of 1.93%. What about the sector's performance during Friday? Red across the board. We're not going to give any medals, but the outperformers, utilities and healthcare. Meanwhile, the laggers of the day led by energy, materials, and technology. What about the sector's performance for the week? It's a similar story here. Utilities outperforming. Meanwhile, the laggers led by energy, materials, and industrials. Moving on to the futures market performance on Friday. Let's see what happened there. We saw muted activities in crude oil. The dollar managed to close pretty much flat. It went up, it went down, but closed on the flat line. However, it was a good week for the US dollar overall, and that kept oil prices muted. What about softs? We saw gains in coca, cotton, and the leader for the day, sugar, acting sweet as it should. Meanwhile, the losers during Friday's session, led by OJ, coffee, and lumber. What about metals? Modest gains for gold, platinum, while we saw declines for copper and palladium. The outstanding story remains for silver. Silver closing the session over 4%. And over the weekend, we heard about shortages in silver because a lot of the crowd who's chasing the YOLO names, once they get shut down by the brokers' houses, they have decided to migrate to the safety of silver. And the question is, are we going to see a squeeze in silver as well? That remains to be seen. But for now, silver is sexy. What about meats? We saw sizable declines here for feeder cattle. Meanwhile, live cattle closing modestly in the red, and lean hogs closing just about half a percentage point in the green. What about grains? Big gains once again for corn, wheat, soybean products, with exception to soybean oil futures closing modestly in the red. Meanwhile, the laggard of the day led by canola futures closing almost 1% in the red. And what about the big casino? The options market, what's going on here? The Apple table leading the day once again with about 3.3 million contracts exchanging hands on Friday. About 66% of those were calls. Coming up on number 2, AMC with a little over 1.1 million contracts, but 63.5% of those were calls. Nokia, number 3, with about 1.3 million contracts, but 84% of those were calls. And did we see any unusual activities in the options market during Friday's session? Yes, we did, but the activities were somewhat muted due to the restrictions from certain brokers led by Robinhood. And here are some trades for the ticker WBA, Walgreens. In this case, they're buying the 57.5 calls, expiration date March 19th, with expectation that the name would rally over 14.5% by then, and they are paying about $1.18 a piece to enter this trade, bringing the total to about $5 million. What about this trade for the ticker SABR? This is for Sabre, and it is, by the way, not the hummus company. It is a software company. And in this case, they're buying the 9 puts, expiration date April 16, with expectation that the name will decline over 16.5% by then. They are paying about 85 cents a piece to enter this trade, bringing the total to about $1.7 million. And of course, we will try to avoid talking about GameStop and AMC because these stocks have become a casino and the options premiums are so elevated at this point it is not worth it to trade these options. You have no clue if all of these brokers are going to shut down once again next week in these names, and you'll see a lot of these options expiring worthless once again. So I'll try to avoid talking about AMC, GameStop, and the rest. But let's talk about this trade for the triple Qs, the NASDAQ. What's going on here? Somebody's buying the 295 puts, expiration date March 12th, and they are expecting the Qs to decline over 6% by then, and they are paying about $7.50 a piece to enter this trade, bringing the total to over $12 million. Somebody's betting $12 million against the NASDAQ. And you see another trade for the Qs here, and this one is a little more extreme, going further, buying the 253 puts, expiration date March 19th, with expectation that the Qs will decline over 19.5% by then, and they are paying about $2.50 a piece to enter this trade, bringing the total to about $2 million. Here's another big trade for Airbnb, the ticker ABNB. They are buying the 200 calls, expiration date February 5th, meaning this upcoming week. They're expecting Airbnb to climb over 9% by then, and they are paying about $4 a piece to enter this trade, bringing the total to about $3 million. It's a very risky trade. You have very little time for it to work, but we are seeing all of these heavily shorted names being squeezed. Airbnb could stand to benefit here, at least in the short term. Continuing with interesting trades. Here's a trade for the XRT, the retail ETF. And remember, the XRT has been on a tear because it is heavily positioned in these short squeezed names. One of the largest holdings in the XRT is GameStop, so it is set to benefit when GameStop rises higher, meanwhile suffering huge declines when we see GameStop trading lower. And a lot of traders now are trading the XRT as a proxy of GameStop because the option premiums for GameStop are absolutely insane, out of whack, don't make sense at all, way overpriced. So they're playing GameStop via the XRT. And here is somebody making a big bearish bet, buying the 68 puts, expiration date March 19th, with expectation that the XRT will decline over 23% by then, and they are paying about $4 a piece to enter this trade, bringing the total to about $1.5 million. Here is a very interesting trade for the ticker PLAY, P-L-A-Y. This is for Dave and Buster. Now, we have seen massive short squeezes in bankrupt companies, struggling companies such as GameStop, AMC, etc. And in this channel, we called AMC before it happened, so perhaps we will do it again with this ticker, Dave and Buster. It is a heavily shorted name, but it did not move as violently and impulsively as we saw with GameStop and AMC. So is the next short squeeze going to happen in Dave and Buster's? And here it is. They're buying the 40 calls, expiration date this upcoming Friday, with expectation that the name will rise over 17.5% by then, and they are paying about 70 cents a piece to enter this trade, bringing the total to about $250,000. We'll keep a very close eye here on Dave and Buster's. And what about this ticker MARA, M-A-R-A? This is a proxy for Bitcoin, and perhaps if we see more shutdowns from brokers like Robinhood, etc., will we see the money migrating toward crypto? That remains to be seen, but somebody's making a bullish bet here on MARA, buying the 24 calls, expiration date February 5th, this upcoming Friday, with expectation that the name would rally over 16% by then, and they are paying about $1.90 to enter the trade, bringing the total to about $500,000. And the last trade I want to show you today for the ticker SPLK. This is for Splunk, and this name has been punished severely for a while. It's been trading lower. no movement whatsoever. Somebody's betting that the name is going to start to rally higher, buying the 180 calls expiration date February 12th with expectation that the name would rally over 9% by then, and they paid about $2.50 to enter the trade, bringing the total to about $700,000. Moving on to the headlines that shaped the day, starting with macro news. We received some inflation data. Here it is. The December PEC inflation came about 1.3% year over year versus the 1.2%, and that was the estimate. The prior month reading was 1.1%, so we're seeing inflation picking up just slightly here from the PCE perspective. But we also received more economic information regarding inflation. Here it is. U.S. labor costs rise solidly in the fourth quarter. Here are the details. The Employment Cost Index, the broadest measure of labor costs, rose 0.7% last quarter after advancing 0.5% in the third quarter. That lifted the year-on-year rate to increase 2.5% from 2.4% in the third quarter. Furthermore, wages and salaries increased 0.9% after gaining 0.4% in the third quarter. So we saw a significant uptick here in wages. And remember, the Fed decides to ignore all the signs of inflation that we are seeing already in the economy, from food prices to lumber prices to home prices. All of that doesn't matter to the Fed. They're blind to all of that inflation. But when inflation starts to creep up in wages, that is the point when they start to freak out and have to put a cap on the rise in wages. For now, they're saying that they want higher inflation, so they will let wages go higher and higher until they reach a cap, and then they have to do something to curb the rise in wages. Because God forbid, when your wages go higher, all of a sudden we have to fight inflation. But when we have food prices rising higher and higher, causing a massive hunger crisis in America, the Fed doesn't bother to do anything. Here's a little more. Inflation is expected to pick up this year and breach the Federal Reserve's 2% target, a flexible average, as weak readings last March and April drop from the calculation. Price pressures are also seen boosted by a strengthening in economic growth driven by fiscal stimulus and the inoculation of more Americans against COVID-19. So expect inflation to rise higher and higher and higher. And while that would be good for the economic recovery in the short term, it is certainly not good news for the stock market, specifically the high growth names. The high growth names are taking a double whammy now. The rise of inflation and the liquidation from hedge funds to cover further shorts in the YOLO names. And we have more macro data for you. Personal savings rate ticked up in December for the first time since April 2020, now at 13.7%. What do we read from this? That the consumer is not spending as expected. The consumer is deciding to save rather than spend due to what? Number one, the shutdowns that we saw during the fourth quarter due to the rise of COVID-19 infections. Number two, the economic uncertainty. The crisis seems to have prolonged way longer than any of us expected. And when we see uncertainty in the economic recovery, when people start to worry about their job security, you see the savings rate ticking higher again. But when you look at the chart, all of that savings, once the economy reopens, has to find its place in terms of spending in the broader economy. Meaning that once we achieve the vaccination objectives and we reopen the economy, we will see an uptick higher in spending, once again adding pressure higher on inflation. But for now, here it is. U.S. consumer spending falls for a second straight month in December. So once again, everybody was expecting a strong holiday sales season and a splurging, etc. That did not happen. What happened is that consumers decided to save more and be a little more cautious. Furthermore, we did not see the stimulus hitting bank accounts in December. So I expect this number to improve in January, and we will see consumer spending adding more to the picture in inflation. What about the housing market? Here it is. Weaker December pending home sales down 0.3% versus down 0.5%. That was the estimate. And the prior reading was minus 2.5%. Overall level, the top panel, as you see in the chart, still cooling from the August peak, but remains high relative to history. Elevated demand without significant boost in supply will continue to put upward pressure on prices. The housing market remains in a bubble, absent of the supply to lower all of these prices. It is certainly a seller's market, not a buyer's market. And here's the last bit in macro news. Despite slower December growth in new orders, economists said the report reflected positive trends for the U.S. manufacturing industry and business investment. Really? And rumor has it these economists also said that the fact that their wives decided to cheat on them and move on with the Cabana boy also reflected positive trends on the prospects of their marriages. Moving on to sentiment news. Here is the first bit of information. The call options mania goes on. New record for daily call options volume set yesterday. 3.7 or 37.8 million contracts. The prior record was 35.7 million in late November. So once again, the casino's hot, hot, hot. Gambling, taking massive amount of risk, no regard whatsoever whether they lose money or not. They're going all in, Naruto style, heads first, buying out of the money calls, expiring the very same week. This strategy has been working and working and working, but perhaps we're about to see an end to the success of this strategy, and that will result to a massive slaughtering in the retail side. And here it is. This is beyond anything we have seen before. This is the mother of all bubbles. 1999 doesn't come anywhere near this. This is the most dangerous bubble that we have ever experienced in financial markets. And it's all done via the riskiest strategy of buying call options. And now we have reached $44 billion spent on call options. And since the beginning of this year alone, that number has risen from 30 billion to about 45 billion. We're talking about $15 billion that were spent in call options buying. $15 billion, and we're assuming that is from the stimulus money, was spent in the casino with no guarantees whether the traders are going to make money or not. And that would add further pressure on the prospects of a next round of stimulus. There will be a lot of resistance here, because giving people another round of stimulus, $1,400 that will go once again inside the casino, will be absolutely suicidal for the economy and unnecessary to add that debt for future generations to deal with. The government is not supposed to subsidize the gambling habits of the population. And by the way, when these options expire worthless, where do you think the money is going to go? To the pockets of Morgan Stanley, Goldman Sachs, JP Morgan, etc. Meaning it is one of the greatest transfer of wealth from the poor and the middle class to who? The ruling class and Wall Street. More in sentiment news. Here is the Russell 2000 index. You see it in white. Meanwhile, we see the trailing 12-month earnings per share in red. And the distortion could not be any more comical. The Russell trading at all-time highs. Meanwhile, the trailing 12-month earnings per share trading pretty much an all-time low. Do you think this price distortion is sustainable or what? But this is what the stock market has become. A massive casino of speculation, a wild jungle with no regulations or watchdog whatsoever. And this is the result right in front of you. Get the hell out while you still can, because this is not sustainable at all. Meanwhile, here it is. Robinhood, US mobile app downloads at all-time highs. The mania goes on. The retail side of the trade going all in, downloading Robinhood. Everybody's chasing the mania. This is the clearest sign that we have reached the market top. And while the retail side continues to chase the mania, what is going on in the insider side? Here it is. Corporate insiders have rarely been as bearish as they are right now. You see that the reading is pretty much the most bearish that we have seen in about a decade. And I showed you another chart, and I will show it to you again when we discuss the GameStop situation, that insider selling has also reached the highest level in decades, indicating that we're about to witness the biggest slaughter of retail investors and traders that we have seen since the year 2000. And this is a good stop for us to segue to the GameStop situation and why I believe that this is, unlike the narrative that's been sold to us, that this is an uprising from retail traders against Wall Street and a David versus Goliath type of situation. It is, in fact, an inside job. And all you have to know to come up to this conclusion is, when the dust is settled, who will win from all of this mania and who will lose? And you will come up with the same conclusion that I came up with. Let me start by this. This is the rally the retail investors have built. Meaning, after we saw the massive sell-off from the COVID-19 crisis, the Federal Reserve decided to usher the tsunami of liquidity to subdue any concerns about bankruptcies and failure in the corporate side. However, the Federal Reserve doesn't buy stocks here in the United States, unlike the Bank of Japan. So who was responsible for recovering the market and creating one of the most impulsive rallies that we have ever seen in the history of the stock market? Part of it was institutional, just to spark the rally. However, the fuel to that rally was the retail investor. We saw lockdowns, people staying at home, saving money instead of spending money, and trading is very easy. Downloading Robinhood on their phone, using the money they're saving to invest in the stock market, and in process creating one of the most impressive rallies in history. Matter of fact, since the March bottom, the S&P 500 has rallied over 75%. We're talking in less than a year. In turn, corporate insiders on Wall Street have become richer than ever. And we saw the wealth of corporate insiders such as Jeff Bezos and Elon Musk skyrocketing while Americans suffer waiting in food lines during the COVID-19 crisis, creating this distortion in our economy, in our society, the wealth gap between the rich and the poor. Retail investors set to benefit from this rally as well. We have seen a lot of success stories of traders turning small amounts of money to very, very impressive gains. But we know from history that retail's participation in the stock market is not welcomed by Wall Street. It is only allowed and encouraged in times when Wall Street wants us to make them richer, encouraging the retail participation to create asset bubbles and engage in very risky investment behavior. And we saw that happen back during the dot-com bubble. And once the retail side became greedy, arrogant, irresponsible, pushing asset prices to bubble territory, Wall Street decided to cash out and then pull the plug on the rally. And you saw the massive crash in 2000, and retail traders, the majority of them, lost all of their gains and all of their investments. And we did not see retail participation joining the stock market once again for about 20 years, all the way until the COVID-19 crisis. And then we saw retail participation surging higher than we have ever seen before. Mission accomplished. Wall Street recovered their assets, and now they've been dumping stocks, cashing in, and they no longer need retail participation. Equity prices reached bubble territory. Wall Street knows it, and the retail side knows it too, but continues to engage in very risky behaviors of investing, unlike Wall Street and corporate insiders who booked their gains. And there are three main objectives of this inside job, in my view. Number one, flush out and destroy the retail participation. You've already accomplished your objective from the retail participation. Now you no longer need them. What you need is obedient workers to go back and work in the economy. We're about to reopen the economy after the vaccination. If these retail traders continue to make money on Robinhood, they no longer need to join corporate slavery anymore. Therefore, you need to flush them out of the market and make sure that they suffer maximum pain on their way out, so they won't have any choice but to rejoin corporate slavery. The second objective is to destroy rivals in any competition from hedge funds and the likes. The biggest firms on Wall Street, BlackRock, Vanguard, JP Morgan, Fidelity, Morgan Stanley, Goldman Sachs, they don't want competition to siphon away more money from their business. Number three, destroy Robinhood. Why destroy Robinhood? Because Robinhood was about to conduct an initial public offering in the market, and in this market conditions, with the retail participation white hot and eager to invest in every new IPO, Robinhood was set to become a blockbuster IPO, perhaps raising the valuation of the company to about $100 billion. Robinhood already disrupted the industry and already siphoned away massive amount of money from these big Wall Street firms. Retail traders and investors, and this is a generational thing, prefer to manage their own money and choose their own investment strategy. Is there any better way to do it when you have an app that gives you commission-free trades, ample access to margin, and it is gamified for the ease of use? Why would the new generation of investors ever need the BlackRocks of the world, the Vanguards of the world, when they can manage their own investment? And Robinhood was set to be the next behemoth, the next Goliath to be born if they have a successful IPO. Now, let's talk about each objective in detail, starting with destroying the retail participation in the market once and for all. Now that the objective is achieved and stocks are trading at all-time highs, corporate executives are richer than ever. Wall Street firms have reached their biggest year ever in terms of revenue and net income. Just take a look at the quarterly earnings report from Goldman Sachs and you'll know exactly what I'm talking about. And the question is, how do you flush out the retail's participation in the market successfully? Do you create a sell-off in the broader market? That's not going to do it, because retail continues to buy the dip over and over and over again, and they are invested in some of the biggest companies in the world, meaning the sell-off will not shake out retail's participation out of the market. So what about creating a new shiny object, the shiniest object of them all, that will attract all of the retail participation, distract them away from the broader market and from their successful investment decisions that they have made last year to chase the new shiny object, and that object is GameStop. It has become a global phenomenon, attracting retail money from across the board, knowing that the company is not valued anywhere near where it is trading right now, and it is almost for certain that the stock is going to crash and come back to its reasonable valuation once again. But what about if you create the narrative that this is David versus Goliath, and an upcoming short squeeze, the likes that we have never seen before, will make you richer than ever? They give you a week, 2 weeks, a month, perhaps a little more of this shiny object to grow bigger and bigger and bigger, and you start hearing about inspirational stories about how young investors managed to make enough money to pay their student loans. Other made more money than they have seen ever in their lives, enough to pay their mortgages, college tuitions for their kids, buying a new home, buying new cars, etc., etc., etc. And the sexier the story gets, the more attractive it becomes, and more retail money moves on to chase the story, when we all know the inevitable ending of that story. And that leads us to ask the question, is it really just retail participation? Is it really an organic rebellion against Wall Street that was behind all of this? Or are there wolves in sheep's clothing who are going to stand to benefit the most from this pump and dump?
Incredible implications, and it's not because of retail investors. And let's, I don't want to jump to it unless you want me to, Scott. This is your show, your world. But I do want to just point out, when you talk about 70, 80 million shares traded yesterday alone, Courtney, Josh, my mom, they're not out there able to trade that much stock in one day. That's institutional money. And so, the momentum trade that happened yesterday was absolutely piled on with quants, which is not a bad thing. Like, I want to be very clear. These are strategies that occurred, but the quants, the large index funds, the institutional asset managers that we cover at Loop Capital Markets, those players were involved. So whether it was for the same reasons as the initial retail investors or not, those players were incredibly active, and they had to be given the trading volumes that we saw.
And you might ask yourself, well, the rise in volume doesn't mean that institutionals are participating in the rally. It means that shorts are covering. That is not true. Here it is. GameStop shares that have been borrowed and sold short have declined by just about 5 million over the last week, marking an 8% dip in the short interest according to S3. Only 5 million shares were covered. But we're talking about volumes that exceed 50 to 100 million shares. We saw that happening this week alone, indicating that institutions are also participating in the rally, perhaps orchestrating the rally to begin with. And while the narrative is that the common man has risen to stick it up to Wall Street and defeat all the greed and the bad behavior that's been going on for years and years and years, here is the reality. The top holders, institutional holders that is, for GameStop stock. Number one, Fidelity, with about $1.4 billion worth of shares. Number two, BlackRock, with over $1.1 billion. And you see Vanguard, Susquehanna, and last time I checked, these are not mom and pop stores. These are the biggest firms on Wall Street. So tell me again, how is this an uprising from the common man against Wall Street when Wall Street is set to benefit the most? And here is more. When the Reddit crew targeted a struggling mall owner and sent his shares soaring, the company's biggest investor cashed out. We're talking about $500 million. Yet another illustration for you that this movement is not what we have been told. The people who are standing to benefit the most are Wall Street and corporate insiders. Furthermore, 9 investors, including large fund-running institutions like Fidelity, FMR, and BlackRock, plus some well-positioned individuals, instantly make $16 billion on GameStop stock quote-unquote squeeze. I can see how the common man is winning this one. I can see the uprising from retail traders against Wall Street. What a joke. Continuing, one GameStop shareholder has sold off a stake valued at more than $1 billion. Wall Street is getting richer and richer and richer. And here it is. What about AMC? Is it a different story? Are retail traders winning over there? Or is it Wall Street and corporate insider? Here it is. To me, the whole populist thing is really a sideshow. Wall Street veteran says after private equity firm Silver Lake pulls in more than $100 million by converting debt and selling the theater chain's shares into Reddit-inspired frenzy. These bag holders who invest in this company, they've been holding the bag for a while. This was a golden opportunity for them to dump their shares and leave who holding the bag? Those so-called retail traders who are leading this revolution to destroy Wall Street. Once again, what a joke. What about BlackBerry? Is it a different picture over there? Not really. Here it is. It is not just Reddit day traders. BlackBerry CEO John Chen gets a $90 million bonus if BlackBerry trades at 30 or above for 10 days. And what about all the surge in volume? Who's benefiting from all of this? Trading volumes have surged, moving way beyond the levels we have seen during the global financial crisis. All of the clearinghouses, Citadel, Goldman Sachs, JP Morgan, all of these big Wall Street firms are laughing, having a great time watching all of that volume surging while they become richer in the process. Once again, is this the populist uprising that the media has been selling to you? Think again. Investment firms are the big winners of the GameStop stock revolution so far. Individuals spending hundreds or thousands of dollars on GME, that's GameStop stock, and they are up for now, but the positions of firms like BlackRock are worth billions. The dominant narrative of this saga is that it is essentially a massive wealth transfer from institutional investors and hedge funds to quote-unquote average people who still have enough money to invest in random stocks during a pandemic. This is true to a degree. People have posted stories of now being able to cover medical bills thanks to GameStop stock. And the original $50,000 investment of the Redditor who started the craze is now worth tens of millions of dollars. Bolstering the narrative is the fact that these folk have absolutely demolished large hedge funds that bet against GameStop, giving it a David versus Goliath flavor. But even as the crusade continues, this isn't a simple story of the little guy winning. The entities that own the majority of GameStop stock are also humongous investment firms and private equity. These entities, such as Fidelity, BlackRock, all own millions of GameStop shares each. Individual day traders spending a few hundred or $1,000 on GME stock are making a bit of much-needed money, but these institutional funds' positions are now in the billions. Take BlackRock, the massive investment fund, which seems to own a chunk of every company, including 13.2% of GameStop. BlackRock owned about 9.2 million shares, worth about $174 million in December 2020, according to an SEC filing published on Tuesday. The stake is now worth about $3.1 billion. But wait, there is more. As short sellers scramble to cover their position, an investor like BlackRock is in a good position to help with something called securities lending, where quote-unquote mutual funds lend stocks or bonds to generate additional returns for the funds. If you are a short seller that needs to cover your position, you can always ask BlackRock to borrow some of its GameStop shares, pay them a fee, and offer up collateral equal in value to the market value of the loan GameStop shares. GameStop's other big investors are also seeing their positions rise in value. Board member Ryan Coyne, who paid roughly $76 million for his 13% is also sitting on a stake approximately worth $3 billion. There is also Donald Foss, founder and former chief executive of subprime auto lender Credit Acceptance Group. He bought 5% of GameStop last February for $12 million. It is nearly worth $1.2 billion now. You see all of that talk on Reddit and the likes saying, oh, keep holding, because the shorts are gonna cover. Well, as shorts cover, there's all these big sharks waiting to dump. Sinvest Management is a New York hedge fund that snapped up 3.6 million shares in October for $43 million. A stake that is now worth north of $1.2 billion. Yet another hedge fund investor, Permit Capital, revealed that it had 4.79% stake in GameStop in September, then worth $21 million and now worth just over $1 billion. The Vanguard Group, as of July 2020, owned 5.4 million shares, a little over 8% of GameStop, worth $21 million then and $1.8 billion now. Vanguard also offers securities lending. By the way, there's a tsunami of selling that is about to happen. Keep buying the bullshit narrative that shorts are going to be squeezed and they're going to buy, so continue to hold. Wait till these guys start to dump on your little heads. The same is more or less true for other companies being pumped by Wall Street bets. They may have netted pretty returns on AMC by pumping up the stock. Its major investors and private equity firms, hedge funds, and asset managers like Silver Lake Group, BlackRock, Greenvale Capital, Vanguard Group, and the Millman Investment Management. Wall Street bets may have wounded a few greedy hedge funds, but it is also for now stuffing the pockets of some while further enriching other shareholders that will lend securities to who? To the hedge funds who are stupid enough to double down on shorts or enter the position without any sort of hedge. So once again I ask you, is it really the populist uprising to destroy and bankrupt all of these greedy hedge funds? Or is it just a misguided movement that is set to achieve the sinister goals of a much, much bigger player hiding in the shadows? GameStop's current valuation will eventually pop, but even if it shoots down to $20 per share, the firms that own GameStop will still be in a better position than they were while a bunch of retail investors will probably flame out. At the end of the day, the stock market is still a glorified casino with none of the aesthetic value. That means you can walk out of there with 1 million, 100 million, or 10 billion, but as long as the house is still standing, the house is still winning. And if you look at the investors for these companies, it is very clear that the house is still standing. And if you're not convinced yet, here is more from Reuters. Analysis: how Wall Street gains from the quote-unquote populist trading movement. Steep gains in shares of GameStop Corporation and other stocks this week have been described as a populist market revolt. But among those out ahead are some of the Wall Street's largest asset managers, which can realize gains both from their share stakes and from lending out stocks to short sellers. Other beneficiaries include market makers and trading systems that profit from huge volumes. This is starting to sound like the best thing ever to happen to Wall Street. Many investors have not realized their profits by selling shares, and some platforms could later face disillusioned retail customers who bought into the rally too late, said Larry Harris, a former chief economist for the U.S. Securities and Exchange Commission and now a finance professor at the USC Marshall School of Business. Hedge funds betting against the stock were forced to cover their positions, costing them billions of dollars and adding fuel to the rally. That was good for funds like the Fidelity Low Price Stock Fund. It held 2 million shares of GameStop, according to a recent disclosure, worth close to $1 billion. At GameStop's peak price of $482.95 on Thursday, before closing at $193.60. The stake would have been worth around $33 million at the start of January. Massive gains. Asked if the fund might sell the shares now, a Fidelity spokesman said via email that to protect fund shareholders, quote-unquote, We do not disclose intent for any potential buy or sell decisions. Brokerage and market makers such as Charles Schwab and Citadel Securities also stood to gain from higher than average volume. Volume in U.S. exchanges on Thursday was 19.58 billion shares compared to 14.86 billion average over the last 20 trading days. Quote unquote, the higher the volume of trading, the easier it is for them to make money, said Georgetown University professor James Angle, who studied market structure and regulations. You still believe in the bullshit narrative of David versus Goliath, the populist uprising to take down Wall Street? What a joke. What a colossal of stupidity that we're seeing in the media right now. And what will happen to GameStop stock, by the way, after the Fidelities of the world decide to dump? Here it is from the Wolf of Wall Street.
But is there a chance, I have a question about this, is there a chance they stop, again, you could sell off what you had, but you couldn't buy. Is there a chance they did it because you and I both know this thing, in all likelihood, and I'm not the expert, is probably going to go crashing down. I think you'd probably agree with that. They're going to come back down to earth probably sooner than later. You agree with that?
It's a guarantee.
Guarantee.
It's a
Okay.
certainty. Yeah, it's a guarantee.
A
yes.
certainty.
Yes.
All right.
It's impossible to overstate the significance of this, just based on what you're telling me here. And I just wonder, whether, on a broader scale, if we're actually looking at, almost on the edge of a sort of stock market bubble here, that we could be in a sort of difficult position in the months to come.
You're hitting all the right points here, that's for sure. So, yes, I mean, this is 1999 all over again. And that's why I said I'm begging everybody to please be careful here. I had someone fixing a TV in my house yesterday, and the guy says, "Oh, my mother called me. She's 82, and she was asking me about GameStop." I'm like, "There you go." And that's how it really gets bad, because when that last group of people start getting in, typically they call it the odd lot theory. That when the average person gets in, that's the time it's going to actually crash. But again, you never know when that moment's going to come. It's going to come, of course, because things will eventually seek their fundamental value. But I would urge, again, I just keep saying it because, it's a wonderful opportunity for people to make money. Everyone's bored and locked up. But just be careful and make sure that whatever you invest in these type of hot stocks, make sure you invest only what you can afford to lose. And if you happen to make money, pull the original investment out and play with the house's money. That's my advice to everybody.
And by the way, all the billionaires, quote-unquote activists, who've been egging on traders and retail investors to join this mania and buy GameStop stock and stick it up to Wall Street, are not doing the same. They're not buying GameStop stock. They're not putting their money where the math is. Here's Mark Cuban. All of a sudden, Mark Cuban, who egged on retail traders to continue in their purposeless jihad, all of a sudden, here he is. Billionaire Mark Cuban says he has hedged the heck out of his portfolio. Wait a minute. You're urging retail traders to take the most extreme risk so you can stick it up to a couple of hedge funds. Meanwhile, you're hedging the heck out of your portfolio. And let's shift to talk about the second objective of this inside job, destroying rivals and competition. Let me ask you a question, and please raise your hand, even though I cannot see you. But raise your hand if you've ever heard of Melvin Capital before this whole thing started. Back in December, how many of you heard about Melvin Capital? Raise your hand. Nobody. I've been in the business for a while. I've never heard of them. So why is this fixation from the so-called Reddit movement to take down Melvin Capital? What's going on here? Here's the headline. Hedge funds face new threats from traditional asset managers. Bargain hunting investors are starting to choose multi-asset strategies over hedge funds. It's been a war that's been going on for a while between asset managers, the biggest firms of the world, BlackRock, etc., versus hedge funds. And even within hedge funds, there is a civil war where bigger hedge funds don't like to see smaller hedge funds succeed and siphon money away from them. So what's going on with this Melvin Capital? Here it is. Melvin on Monday took an unheard of cash infusion from its peers, receiving $2 billion from Griffin, that is Ken Griffin by the way, his partners and hedge funds he runs at Citadel, and about $750 million from his former boss, Stephen Cohen. The social media posts about Melvin Capital going bankrupt are categorically false, a representative said. Melvin Capital is focused on generating high-quality risk-adjusted returns for our investors, and we are appreciative of their support. Here it is, the most important part. Until this year, Plotkin, this is the guy who's running Melvin Capital 42, had one of the best track records among hedge fund stock pickers. He'd worked for Cohen for 8 years and had been one of his biggest money makers before leaving from Melvin. He's posted an annualized return of 30% since opening, ending last year up more than 50% according to an investor. Ask yourself, is this a threat or not? If you're watching this hedge fund that started a few years ago, all of a sudden posting 30% annualized return and 50% last year, outperforming all of these hedge funds, isn't this a prime target to take down? Of course it is. Let's go to objective number 3 of this inside job, destroying Robinhood. Here it is. Robinhood's next adventure, stealing market share from the rich. The startup stock trading app has become a huge hit, but to become profitable, Robinhood will have to woo more clients away from well-financed competitors. And here it is, furthermore, how commission-free trading may ultimately hurt ETFs. We're talking about BlackRock, Vanguard, Fidelity. They're all going to get hurt if we see the rise of Robinhood. And remember that Robinhood disrupted the commission business of broker houses. Here's from Barron's. Charles Schwab and the new brokers' wars. Wall Street is looking at retail brokerage too. Investors with banking relationships at Merrill Lynch unit of Bank of America and JP Morgan Chase can trade free on a limited basis. JP Morgan CEO Jamie Dimon mentioned Schwab 7 times in a recent meeting with analysts, more than any other rival, according to Chubak. Here it is. Dimon said that he would do whatever it takes to defeat competitors. Once again, Dimon said he would do whatever it takes to defeat competitors. And forget about Charles Schwab. He'll deal with that later. The biggest threat right now is Robinhood. And let's talk a little bit about Robinhood, because Robinhood is in a lot of trouble. And they could go bankrupt very, very soon. I took all of my money out of Robinhood on Friday. And just for people to understand, part of the reason that they shut down on Thursday was sinister. Perhaps there was collusion between them and Citadel or another hedge fund firm. But the biggest part is they had to shut down because if you bought call options on AMC or GameStop, and the stock now has surged significantly on Thursday, at least pre-market, all of these call options are now in the money and traders are looking to close them, meaning somebody has to pay these traders. Robinhood decided to become its own clearing house, which is the lethal mistake, by the way, and all of a sudden they found themselves in trouble because they cannot pay all of these traders. They don't have the money to pay them. So they had to shut down and raise money to do so. Meaning that if you held AMC or GameStop calls on Thursday, you were cheated out of the gains that you could have booked. You have a legitimate case to raise against Robinhood. The take here is they have raised $1 billion overnight. They only have $1 billion on hand right now to pay everybody, meaning that on Monday, my recommendation is if you have an account with Robinhood and you have your money still there, you gotta take your money out, because if they run out of money, if they declare bankruptcy, if we see another short squeeze next week and they get hit very hard with options and they declare bankruptcy, your money is pretty much frozen. They're not going to be able to pay you. So take advantage of the $1 billion before it's gone, because you're going to get your money eventually, but that's going to take months before the money is unfrozen. And just check out how nervous Robinhood CEO is.
Comes next, Bloomberg is reporting that you've drawn down your credit lines. Why did you do that?
Well, going back to the market volatility, which increases the deposit requirements at various clearing houses that we have to deposit cash into, the more cash we have available to deposit at these clearing houses, the more we can allow customers to buy, especially of these stocks unrestricted. So we're obviously interested in removing restrictions and removing the restrictions as per our operational requirements, and increasing the amount of cash available to fund these deposits will allow us to better do that to the greatest extent possible.
You've also been hit by some lawsuits. Are you prepared to deal with the avalanche of complaints, the people who want to sue you? And do you have enough capital to clear these trades on top of it?
Well, we understand that people are upset when they want to buy a stock and they're not able to for some time. So we obviously stand with our customers in allowing access, giving the retail investors the ability to buy and sell stocks, and we'll continue to do so. We'll continue to do so, and our focus right now is on serving them and making our service as reliable and stable for them during these unprecedented market conditions.
And this guy looks like a nervous cat. It looks like somebody is holding a gun to his balls under that shot. And here is a tweet. So if Robinhood goes under, the SEC will freeze all the accounts. The SIPC protects up to 500,000 in accounts. It takes months to unwind and get your money back. Move the money now. This could become a nightmare and indeed a reoccur. Move your money out of Robinhood. You could get slaughtered here and your money is going to be frozen. You're not going to be able to do anything about it. But that is the third objective of this inside job. Accomplished. Destroy Robinhood. Robinhood might emerge from this crisis. They might raise another batch of money. But the most important aspect of the story, the IPO, that is gone now. It will never happen. And let's address, after all of these facts that I showed you, let's address the bullshit narrative. Here is a post from Wall Street Bets, and this is the narrative that has been running right now in the media. The post says, "This is for you, Dad." And this is a kid saying that what he's doing right now with GameStop stock is a revenge for his father who lost his concrete company during the 2008 crisis because banks cheated him. And he said, "This is all the money I have and I'd rather lose it all than give them what they need to destroy me. Taking money from me won't hurt me because I don't value it at all. It'll burn it all down just to spite them. This is for you, Dad." Spite who? Who are you spiting? I just explained to you, your money that you're wasting is going to benefit the same Wall Street banks and large firms who cheated your dad. What kind of stupidity is this? This is the false narrative that is running rampant right now in social media and even in the corporate media. And here is more about the cesspool of misinformation in social media. Everybody creates an account, posts that dumb icon, and start pumping stocks, pretending that there is some holy cause behind it. Here it is. Today is the expiration day for people who bought Tesla July 29th put options. Let's buy Tesla shares in pre-market and let put options expire worthless today. People should invest in a company for it to succeed, not hoping for a failure. Retweet and spread the message, please. And this post has over 3,000 likes. First of all, the July 29th puts do not expire in January 29th. They expire on July 29th. You moron. Second of all, if you want to pump the stock, you actually want it to expire in the money, those puts, because the buyers of those puts will have to buy back the stock. The amount of misinformation is absolutely stunning. Now let's address the third point. People should invest in a company hoping that it succeeds, not to fail. Well, the company you're talking about, buddy, is valued at $800 billion. Meanwhile, it barely generates a little over $25 billion in revenue, in sales. It is the most overvalued company on the planet in history. So yes, you have the right to make a bet that this company is not going to live up to its current extreme bubble valuations. The amount of stupidity is absolutely stunning, and it is quite laughable if it was not sad. And let's address this point about the demonization of short sellers as somehow they're market manipulators and destroyer of the average folks and all that garbage. And once again, remember, all the scams and frauds that were discovered by short sellers, all the way from Enron to Nikola. And here is the take, a tweet I published. For people who attack short sellers and think it is a bad practice, you might want to move to China to enjoy the freedom and democracy of banning short sellers, and where stocks only go up, even for fraudulent companies. We have a free market here in America, at least in concept, and part of that concept is short selling is a normal, healthy practice of any functioning stock market. If you want to ban short selling, you might want to move to China. And by the way, where are the shorts? Here is the short interest for the SPY. It is pretty much reading at very low levels, meaning that there are no shorts. And the majority of manipulation that's going on in the market right now, it's happening in the long side. Try to explain to me this. The S&P 500 gains during the trading session, meaning if you bought the S&P 500 during the session and you sold it before the end of the day, every single day since March 2020, the S&P 500 did not move at all. At all. Matter of fact, it lost value. Meanwhile, the overnight pumping that's going on in the pre-market for the SPY is responsible for moving the index to gain over 40% since March 2020, meaning that this is a classic market manipulation. It's only happening in the long side. This is why nobody's complaining. If everybody's making money from this, nobody complains about market manipulation when it happens in the long side. What about this? Bitcoin soars 11% after Elon Musk name checks on Twitter. So Elon Musk changes his bio, Bitcoin surges 11%. This is not market manipulation? Oh, but it's happening in the long side, so nobody's complaining. Even for frauds, here it is. Elon Musk tweets in support of Dogecoin after price grows 420% in a day. And once again, I ask you a question. If you want to be honest and you want to blame the hedge funds and say the shorts are manipulating the market, isn't this market manipulation? Here it is. Virtual currency Dogecoin, which originally started as an internet parody based on a viral dog meme, is the latest target of hype-up Reddit users. Once again, if you invest in this garbage, you deserve to lose your money. But it is market manipulation that happens every day, mostly to the long side. Nobody pays attention because the market has become a jungle with no regulations, with no watchdog whatsoever, bumps and dumps all over the place, backstabbing all over the place, prey and predator kind of behavior. And that takes us to the short float issue in GameStop. A lot of you asked me, how did the short float got to over 100% to begin with? Explained from a mechanical perspective. Here's what happens. Let's say that I'm a short seller and I borrow GameStop shares from BlackRock and then I sell them into the market. That same share is counted twice. Once when BlackRock lend the shares to me, and once again when I sell them in the market. And therefore, when they're counted twice, even though it's the same share, when that is done over and over and over again, you could reach over 100% short float. Likewise, take a look at this stock, COS, one of the stocks involved in the mania right now. Take a look at the volume on Friday, 11.61 million shares. Compare that to the shares outstanding for the company, 7.62 million. So we're trading double the outstanding shares available. How does that happen? It happened because when I buy a share, and then I sell it to you, and then you sell it to somebody else, and then you sell it to somebody else, that same share is counted more than once as independent volume. And once again, if you want to complain about the short float exceeding 100%, aren't you complaining about the volume of a company exceeding more, in this case double, the shares outstanding? Or is this just an issue of hypocrisy and an opportunity to exploit, and it has nothing to do with legitimate grievances? And there's a lot of misinformation on Reddit and the likes saying that you should hold your GME shares because shorts have to cover. The 120% short float has to be covered, meaning that it has to go down to zero. That is categorically false. It doesn't have to go down to zero. And here it is. GameStop short sellers are still not surrendering despite nearly 20 billion in losses this year, meaning that some of them are not going to cover at all. Matter of fact, they're going to short more as the stock goes higher. Others will have to cover because they have other obligations that cannot rack all these losses. But for every short who's going to cover, there's somebody else who's entering a new trade and shorting once again. Furthermore, for every short that covers, there is a Vanguard and Fidelity waiting to dump. So be careful of buying this narrative that the stock is going to go higher just because the short float is high. And here it is. Those betting on GME going to infinity don't understand counterparty risk, leverage, or liquidity. Parabolas equal trap buyers equal liquidation. What happens if some of these hedge funds start to declare bankruptcy instead? All of a sudden, their obligations to cover their shorts are pretty much done. They're out of the woods. And you're going to see trap buyers with no shorts to buy from their hands at higher prices. And that leads to massive liquidation, aka the dump. So once you see the headlines that so-and-so fund went bankrupt, that is the point where you understand that the game is coming to an end. I know many of you are going to celebrate that the hedge fund went bankrupt, but that would be the signal that there are no shorts who are going to cover now. They're going to declare bankruptcy, And nobody's going to buy those shares from you at higher prices. And what do I see for the stock itself? Is it going to go higher? I think the squeeze will continue for now, and GameStop could reach higher prices indeed. But here's something you gotta keep in mind. The higher the price goes, the lesser the ease of entry becomes. Meaning, if we go to 400, if we go to 500, 600, 700, it becomes harder and harder and harder for retail traders to maintain this rally because the entry point to buy these shares become very, very expensive and the risk becomes very high and not worth it. What is the magic price here when we reach exhaustion and we have to turn the tide? I don't know. It could be 500, could be 600. You certainly saw in Tesla that people continued to buy even though the stock was trading over $1,000. So we don't know what the price is, but keep this perspective in mind if you are holding shares of GameStop. And also understand the psychology of who's participating in buying GameStop stock right now from the retail side. On one hand, you have the holy warrior side, and their mentality is, I don't care about making money. This is about sending a message. I think that this is misguided, but it doesn't matter. They're not going to change their mind. They think that they're taking down Wall Street, and they are in a holy war, a jihad against whoever. I don't know who that is. I just explained to you that Wall Street is benefiting. This is the best thing that ever happened to them, but that does not matter. The psychology of this type of buyer is set on stone. They are early entrants to the trade. They believed in the cause early on. They bought these shares at cheaper prices so they can afford to pump in social media and promote their cause because they're still in the money and they're not going to be out of the money unless the stock drops way, way down from these prices. They're also less sensitive about price volatility. They're not fazed by it because they're early entrants to the trade and they do not care about losing money. They're only going to take profits if it's clear that this hype is over and done, meaning that GameStop goes down to say $10 and the whole thing is over, then they will take some of the profits or losses in this case because the cause is done and there is still some money left on the table. They're also likely to be already invested, they're all in, and they don't have any more money to buy any dip. Now contrast that with the other hand, the FOMO crowd of the retail side who are buying GameStop right now. They don't care about sticking it to the suits or Wall Street or the holy war. They just see an opportunity for a quick profit. You invest a small investment, you double, triple your money, and then you're out. They're likely to be late entrants to the trade. They're more sensitive about the price volatility, meaning if they see GameStop dropping lower, they start to panic, they start to take profits, and they betray who? The holy warrior. But they are also part of the FOMO crowd who are still waiting in the sidelines. They believe that the prices right now are too high, and they're waiting for a dip. When we see a dip, that dip will be bought. So just keep these perspectives in mind. That the stock could go down really fast, and the FOMO crowd exits, but another FOMO crowd joins and buy the dip. So this thing is far from over in my opinion. There's still more juice to the rally in GameStop unless the SEC crashes the party or we see more manipulation from brokers restricting trades. I hope this is clear for you. We spent a lot of time here, but after all the information that I presented to you, you are no longer in doubt that this is not about a populist movement, about the common man rising against Wall Street. It is the dumbest narrative I've ever heard. This is an inside job from Wall Street to accomplish three things: flush out the retail trader, destroy rivals, and destroy Robin Hood and other brokers who are intending in disrupting the game for the big Wall Street firms. Back to our normal market coverage. Moving on to the heat map analysis. What do we see here for the activities this week? Here it is a sea of red across the board, with exception of companies that reported good earnings, such as Microsoft, Triple M, Abbott Laboratories, Canon, the ticker CAG. You see it right there in the technology sector. However, we also saw rallies in names that are heavily shorted, such as VMware, Palantir, General Mills, Kraft Heinz, Kroger, Illumina. You saw a lot of shorts covering in names such as Kroger, for example. And we're talking heavy short covering. And the reason is they don't want to be caught with their pants down if, say, Kroger becomes the next Wall Street bets target to hunt down shorts. And all of that short covering money has to come out of somewhere. And it's going to come out of Apple, out of Amazon, out of Facebook, out of Tesla, out of Adobe, all the names where hedge funds are concentrating their long positions. Moving on to the weekly heat map for the ETFs in the market. A sea of red across the board with very few exceptions. We saw inverse indices having an excellent performance this week. Whether you're talking about inverse indices for the Dow, for the Qs, for the SPY, it didn't matter. We also saw inverse indices for the IWM outperforming, such as the TZA, up about 14% or so for the week. Similarly, we saw massive gains for proxies of the VIX. We're talking about the UVXY up over 43%, the VXX up over 28%. Meanwhile, the only gainer here in all of these bull ETFs, or long ETFs I should say, is the XRT, the retail ETFs. Why is that? Because one of the largest holdings in the XRT is GameStop. This is why people are treating the XRT as a proxy for GameStop. And while we saw muted activities for miners and commodities in general, we saw massive gains for silver. You see the ETF for silver, SLV, closing the week over 5.5% in the green. And the reason is all the speculation that silver could be the next target for Wall Street bets to trigger a squeeze or a rally in this case. And we are already seeing a shortage of silver across many providers. Moving on to the charts analysis, starting with the 15 minutes chart of the SPY. The beginning of the week, we already talked about when you gap lower and then you march all the way higher and you reverse before closing the gap. It is a very ominous signal, a very bearish signal. You see it happening here in the SPY, and right away we reversed lower, and you see that we tried to hold at the 374 support, failing, and you see the confirmation candle attempting to recapture 374 but failing, and that was the rejection confirmation that we are about to flush lower. For now, we have caught support from where? The level of 369. Will that hold or not? It all depends on this short covering battle. If we see more liquidation of assets to cover for shorts, you bet the SPY is going to trade lower. What do we see in the continuous contract from a daily perspective? Once again, we've been eyeing breaking the trend, the upper limit of the channel. We finally broke it and we had a confirmation, and that is a massive, massive sign of weakness. The next target is 3,600. Breaking 3,600 will be the most ominous signal we have seen in the SPY for a very, very long time. The chart better hold the 3,600 level. It is the most important level of support right now. So this is what you want to watch for the continuous contract. What about the weekly picture for the SPY futures? Take a look at the MACD indicator. The last time we saw that same curling down after a massive run higher was during the COVID-19 correction in February 2020. And that was a massive drop. We saw a fake crossing last year that did not formulate to anything. That was a bear trap, but this one is not going to be if we continue the same trajectory we're in right now. And the correction target for now is to go back to where? The lower end of the trading channel. And that would be about 13% or so correction from the top. That is the target, at least the first target for now. It could stop at 3,600 and bounce. That would be the bullish scenario. The bulls want to defend 3,600. If that doesn't happen, we're going down to visit the lower limit of the trading channel. All in all, a 13% or so correction from the top. Moving on to the Qs from a 15 minutes perspective. Similar story here. Every time we gap lower and we attempt to close the gap, but we reverse before that, that is a very, very bearish signal. That was your sign right there to short the Qs. And you saw the flush down all the way to where? The level of support of 313. Will that hold? I doubt it if we continue to see the short squeeze going on in GameStop and the likes, because all of these hedge fund managers have to liquidate their positions and they are concentrated in big technology names. Moving on to the daily chart, you have all of these support lines and I left them there. And I told you that when the break finally happens, we will go through these support lines and break through them like running your fingers on the strings of a guitar, and it will be music to the ears of bears. And here is the monthly chart of the Qs that I want to show you. And you see the death cross candle right there, indicating the top. We saw that in Apple in the daily chart this week, and that was indeed the top. Will this be the monthly candle top for the Qs? Remains to be seen. but I would not doubt the death cross scandal is here to send a message. What about the IWM from a 15 minutes perspective? You see that the chart struggled to recapture the lower end of the trading channel, back and forth, and it finally got rejected, and we now have a bear flag formation that should lead us lower, as at least from 15 minutes perspective. What do we see in the daily chart? Remember, everybody was eyeing when is the point where I'm supposed to short the IWM, and I told you, take a look at the RSI. We have been in a strong momentum trend since September. Once you break that trend, that would be the signal that the IWM has lost momentum. And where is the target that we're eyeing? The level of 195.5, that would be about 12% or so correction from the top. Absent of a rescue operation, and by rescue operation I mean shutting down trading in GameStop and the likes, or for brokers to restrict trading once again, then you will see flows coming back to the IWM. Absent of that, the flow will be out of the IWM. What about the dollar index daily chart? We've been talking about an ABC pattern for a while now, and it looks like that the ABC pattern will take place if we see a mass sell-off in the broader market, raising more cash. The dollar index will finally finish the C leg higher. What about gold? Gold, once again, from a daily chart, facing the resistance of 1870. It is very hard, and I've been skeptical of buying gold right now, so long as there is a potential for the dollar index to rally higher. What about the weekly chart of gold? What do we see here? There is a mini bear flag formation that could take us lower in gold, perhaps all the way back to the level of 1800 and even below. What about silver? And we're covering silver because of the activities we saw this week. Silver, on the other hand, this is a weekly chart. You see the MACD indicator curling upward, about to make a positive crossing. If it does, that would mean that silver has momentum to the upside, and we could see higher prices. Moving on to the TNX, the 10-year Treasury yield. I've been talking about an ABC formation, and my target was 1% for the B leg. You saw that happening exactly as I predicted, stopping at 1% and then blasting higher. Are we going to formulate the C leg? There are many factors that would determine the success of the C leg or not. The political situation with the Biden stimulus plan and what's going on with the market right now. If we see an exodus from equities and moving money to bonds because people are panicking and losing faith in the market, yields are going to reverse lower, and we're not going to finish the C leg. Keep that in mind. Moving on to the VIX. What do we see in the VIX? Been talking about the wedge formation, and we saw the bull trap when we started breaking to the downside from the wedge, and I told you back then, I do not buy it. And I think that the VIX is going to go higher, and I maintained my position, put my money where my mouth is, and continued to buy VIX calls. And I believe the word that I used is explosion. I said that the VIX is going to explode higher out of the wedge and closing above the very important level of 25. And indeed, the VIX exploded higher, and now the VIX has momentum on its side, recapturing the strength in the trend in the RSI, meaning that there is more juice here for the VIX to go higher. And we are eyeing the level of 41 as the next resistance if we continue to see a rout in the broader market and a rise in volatility. And by the way, let's visit the VXX. This is exactly how I'm playing the VIX. And by the way, show me another analyst on YouTube or otherwise who predicted the explosion in the VIX by studying the chart of the VXX. I told you we're in descending line, and we're about to break it higher. And we saw the curling in the MACD. All of these were signs that the VIX is about to explode higher. Moving on to Apple. What do we see here? Apple flushing down. I wonder why. Money's being taken out of Apple to cover for all the shorts. And for now, we stopped at 138. That did not hold. And that makes the next level of support is 131. And we did stop at 131, but we're starting to look a little weaker here, with the bear flag formation suggesting more downside could be possible for Apple. What do we see from a daily chart perspective? We talked about the death cross formation, and from the very beginning we talked about the donkey mentality of buying the stock ahead of earnings. This is the donkey mentality. Buy first, ask questions later. Matter of fact, don't ask questions at all. And you see that is firing back at the morons who bought the stock before earnings. Moving on to Tesla from a 15 minutes perspective. What do we see here? Similar story with the SPY, the Qs. Every time we see the chart gapping lower and then reversing before reaching and closing the gap, that is an ominous signal suggesting more downside. This is exactly what happened with Tesla from a 15 minutes perspective. What about the daily perspective? And once again, I'm one of the few analysts on YouTube who cover a Tesla chart every single day. A lot of people avoid covering Tesla chart because it is a very hard chart to read. A lot of analysts don't want to embarrass themselves by making a call or analysis that turns out to be wrong. Me, I don't care. I just tell you what I see. And we nailed the top. I told you the 84 level in the RSI will be the top and the stock will reverse and weaken from there. That is exactly what happened. I told you about the bear flag formation and the fact that earnings will never live up to the price right here. We have to see a correction and go down where? At least to the upper limit of the range, the yellow trend line, and that would be about 15 to 20% correction from the top. But ultimately, the price and the strongest support for Tesla here is the level of $5.99. We'll take it one day at a time. Let's see how the stock reacts once it reaches the trend line, whether it's going to bounce or not, and then we'll take it from there. And moving on to conclude this video, what is the strategy for February from the Maverick of Wall Street? We have this tug of war, the yo-yo game between the heavily shorted names, aka the YOLO names, and the broader market, specifically the names where hedge funds are concentrated. And we're going to play that game back and forth, depending on the magnitude of the short squeeze. So how am I planning to protect myself from all of this volatility? Here it is. Number one, I'm currently 70% long, 30% short in my portfolio's holdings with 55% cash. And that cash, of course, will be deployed to the downside if we see the market breaking. Number two, I liquidated the riskiest assets in my portfolio back in November. I'm only holding value stocks in my portfolio. So I'm not worried about these stocks being liquidated heavily. I don't have any of the risky names that they're liquidating from right now. Number three, my short portfolio consists of companies with extreme valuations. The strategy started to pay off and will pay off more as we advance in February and March, because these are the names that will get hurt the most in the event of a mass exodus from equities. Number four, I have been long the VXX. I've added calls back in December and early January in case we see volatility surging higher. I closed some of the calls during the week after the big pop, but I'm planning to rolling all the way to March. I had February calls. I plan to roll to March. Number five, to exploit the current situation, I'm buying March calls for the SQQs and March puts for the XRT. The SQQ puts will protect you in the event if the short squeeze continues and we see a liquidation out of the NASDAQ. The March puts for the XRT is the play if we see the rally in the short squeeze names, specifically GameStop, coming to a crash. Number six, I'm also long the TZA. I bought it earlier this week after we made the negative crossing of the momentum in the RSI. Number seven, to protect my long portfolio, I'm buying February 19th expiration puts on individual names in my portfolio. So if these names come down crashing, I am protected, at least all the way to February 19th. Number eight, I already own a basket of puts on several other names such as Tesla, ARK, the Cathy Woods ETF, the SPY. And I do have calls on one name, the Cheesecake Factory. I closed some of those, but they expire all the way in February 19th, so there is a little more time for the name to go higher, and it is a heavily shorted name, so who knows where the stock is going to go. And of course, I will exploit more opportunities as I see them. And you see that the most heavily shorted names that are being squeezed higher at the moment will present opportunities to short at some point. So for now, I'm just watching them, watching the action. If I see any opportunities, I will exploit them as I see them. Lastly, what do we have in the economic calendar this week? On Monday, we have the PMI and ISM manufacturing indices, and then we have motor vehicle sales. On Wednesday, we have the important ADP employment report, and this time around, the services PMI and ISM index. On Thursday, per usual, we're going to have the initial jobless claims, and on Friday, the big jobs report, the unemployment rate. That would be an important report to see where we are right now in the phase of recovery. That's all I got for you for now, and I'll talk to you again soon.